Imagine a world where your bank deposit is no longer held inside the banking ledger, but lives as a digital token that moves across continents in seconds. What happens when the rail that banks relied upon for decades simply disappears? Today, that is no longer science fiction. It is starting to happen. We are entering a pivotal juncture in global finance. The engines that run payments, deposits, cross-border remittances, and corporate treasury operations are being challenged by a new class of digital money, stablecoins. These are digital tokens pegged to fiat currencies, designed to blend the familiarity and perceived stability of traditional money with the speed, programmability, and global reach of blockchain technology. Traditional banks, the payment networks, and even regulators are shifting their posture. As Christopher Waller, governor at the Federal Reserve Board, put it, "I have been saying this for over 3+ years now about how this could bring competition, efficiency, and speed into the payments system." But he added, "Do I think there's going to be 100 stablecoins circulating after legislation happens? I don't think so." This tension between innovation and control sets the stage for the story we're about to explore. Stablecoins can be broadly categorized into three types: fiat collateralized, backed by traditional currency; crypto collateralized, backed by other digital assets; and algorithmic, which attempt to regulate their supply mechanism to maintain value. For example, fiat-backed stablecoins, such as USD Coin and USDT, dominate much of the market volume. Crypto-collateralized examples include DAI from the MakerDAO ecosystem. Algorithmic stablecoins, meanwhile, have had notable troubles. According to a speech by Waller, stablecoins, the highest profile example of a new and fast-growing payments technology. These tokens seek to move money faster, with fewer intermediaries, less friction, and round-the-clock settlement. They attempt to rewrite the rules of what money and payments look like in the digital age. For banks, this is both threat and opportunity. The deposit-based model is central. Banks gather deposits, use them for lending and funding, and charge fees for payments and settlement. Stablecoins challenge this model in several ways. Banks could gain fast settlement, lower costs, new client services, access to token rails, but they could lose fee income, deposit flight, irrelevance in the payment value chain. Consider the comment by Jamie Dimon, CEO of JP Morgan Chase. "We're going to be involved in both JP Morgan deposit coin and stablecoins. I don't know why you'd want a stablecoin as opposed to just payment." But fintech companies are trying to figure out a way to create bank accounts and get the payment systems and rewards programs, and we have to be cognizant of that. The message is clear. Even the most established banks no longer see stablecoins as fringe. They see them as a competitive imperative. Meanwhile, the Bank for International Settlements warns that the scene is not risk-free. Stablecoins could threaten financial stability, deposit bases, and monetary sovereignty. For emerging market banks, the stakes are especially high. A recent analysis estimates that up to $1 trillion could flow away from emerging market banking deposits into digital tokens in the coming years. The architecture of payments is changing. Traditional systems rely on multiple intermediaries, legacy infrastructure, overnight settlement, geo-bound rails. The promise of tokenized money, near real-time settlement, 24/7 operations, global reach, programmability, smart contracts, programmable invoices, embedded payments. As Waller expressed in another address, if they can do that in a way that opens competition, broadens the reach of the payment system, drives down costs, makes things faster and cheaper, I'm all for it. Payment networks are responding. For instance, Visa's head of crypto, Kai Sheffield, noted, "We don't really think stablecoins solve much of a problem for retail payments in the U.S. The majority of stablecoin volume is generated by high-value transfers, not retail transactions." But what happens in regions where traditional systems are weak? In corridors characterized by high remittance costs, say Africa, Latin America, parts of Asia, the value proposition is stronger. Fewer intermediaries, lower cost, faster cross-border settlement. Some estimates indicate that remittance fees might drop from 5 to 8% to 1 to 2% if token rails gain scale. Banks and fintechs are thus in a race. Will they build the rails, partner, or be sidelined? Some banks are already issuing tokens. Others are watching. The rails are shifting whether incumbents embrace it or not. Innovation without guardrails can lead to destabilization. Regulators are responding. In the U.S., legislation such as the Genius Act has been introduced to regulate stablecoins issuance, reserve backing, and consumer protections. Across Europe and the UK, regulators emphasize that stablecoins must meet standards similar to bank money if they are to be used at scale. The Andrew Bailey, governor of the Bank of England, warned, "It would be wrong to be against stablecoins as a matter of principle, but these digital assets could drain money from the traditional banking system and disrupt credit creation." And as the Fed's Michael Barr stated, stablecoins have the potential to improve the efficiency of the payment system, particularly in cross-border applications. For stablecoins to reach their potential, additional work is needed to create guardrails that protect households and businesses, and the financial system as a whole. Key risk vectors include reserve mismanagement, leading to depegs, run risk, possibly large redemptions in a crisis, cybersecurity and smart contract vulnerabilities, and fragmentation of regulation across jurisdictions. From an investor perspective, the rise of stablecoins opens multiple strategic avenues. First, identify banks and payment firms that are proactively engaging with tokenized rails, either by issuing, partnering, or building infrastructure. These may be positioned to capture both fees and new market share. Second, fintechs and infrastructure providers operating behind the scenes, wallets, custody, token issuance platforms, are innovation plays. Third, geographic corridors with high payment friction, emerging markets, remittances, may see outsized adoption and therefore returns. Fourth, regulatory clarity matters. Firms that navigate regulation early may hold advantage. This is not simply crypto versus bank. Many banks will hybridize. They will issue tokens, become custodians, provide gateways between fiat and crypto. As Waller noted, the private sector should drive payment innovation where regulation creates the level field. Additionally, the nature of value is shifting. As Patrick Collison of Stripe put it, stablecoins will force banks to offer competitive deposit yields or risk losing customers. This signals a structural change. Banks' cheap deposit funding is no longer guaranteed. Stable asset alternatives may compete for capital. We've traced the evolution of money and payments, the deposit-based banking model, the legacy rails, the arrival of tokenized value, and the disruption implicit in stablecoins. Banks face a choice: Adapt and lead, partner, or risk being marginalized as infrastructure providers rather than value creators. Stablecoins are not just a niche crypto phenomenon. They represent a structural shift in how money moves, how payments settle, and how value is captured. For investors, this is a landscape rich with opportunity and risk. Performance will favor firms that embrace token rails, forge strategic alliances, and navigate regulation proactively. Those who wait for clarity may end up as spectators of a change they could have participated in. The future of banking and payments is tokenized, global, and faster than ever. The question isn't if the disruption happens. It is who leads it, how it plays out, and when the value migrates. Your role as an investor is to understand which companies and systems will capture that value and which will be disrupted. If you found this deep dive valuable, please give a thumbs up and subscribe for more in-depth explorations of finance, innovation, and disruption. Share this video with anyone who still thinks payments are boring, because the next wave of money already is. Check the description for references and further reading, and hit the bell to stay ahead of the change.